In this video, I test a very powerful one-bar reversal setup over 40 different charts. I'm doing this responding to a request from Ben, who's a viewer of this channel. The setup which I'm going to test is one I discovered from Larry Williams, in which he calls a smash day setup. And, as the name suggests, smash day, it was originally working on daily charts. However, I'm now going to test 4 different time frames, but they're going to be intraday time frames. I'll leave a link to a previous popular video which I made all about the smash day setup. And one of the variations in there I've actually been using successfully in my own trading for almost a year now. Ben asked me whether I could test the pattern to see if it would work on either a 30-minute chart or a 4-hour chart. So what I've done is I've actually created 4 different tests using the 30-minute, the 4-hour, the 8-hour and the 12-hour chart. So by the end of the video you will have seen how this easy to trade pattern works across 40 different markets timeframes. And I can say now that out of those 40 I found at least 13 which actually show some potential. To speed things up video wise, I've actually created a table listing all the markets and all the time frames, and then I've color coded it to show which markets have potential and which markets the setup definitely doesn't work on. All the tests which I've done are using Oanda Forex data from January 2008 through to September 2022, and we're going to be covering thousands of trades. Firstly, let's just recap what a smash day or a smash bar setup actually looks like. Let's first look at a long setup or a buy setup for a smash bar. So here's our first bar. The second bar is a potential smash bar. This bar here is a smash bar. The reason it's a smash bar is because the close of this bar is less than the low of the previous bar. The minute we see that, that is our setup for a long trade. Now we go long if prices on the next bar break above or rally above the high of this smash bar. So this is our level to go long if on the next bar prices go above it. So if we see something like that, we would have got in at this level here, which is the high of the smash bar. The stop loss is the low of the smash bar. And we do the opposite for a short trade setup. So this could be a short trade smash bar because the close is above the high of the previous bar. Once we see that, we want to put a sell short stop order at the low of the smash bar. So if prices then decline and come through this level, that is where we enter the market. And the stop loss is the high of the smash bar. Now you know what that smash bar or that entry signal looks like. We need to think about what type of exits we're going to use. I briefly discussed this with Ben, and he decided that he'd like to see a 1.5 to 1 reward to risk ratio target as the primary exit. I said okay, and I think another type of exit to test would be a simple end of day exit and maybe even a first profitable close or a bailout exit. However, because I'm running the test on 40 different charts already, running a test on multiple exits over each of those 40 different charts would have resulted in hundreds of different tests. So I did perform a few different tests on some of the markets which did work better, and I actually decided that a reward to risk ratio of 2 to 1 rather than 1.5 to 1 seemed to work a little bit better across the board. So the only exit we're going to use is a target of a fixed 2 to 1 reward to risk ratio. Some of you regular viewers will know that I do most of my testing and my trading on the multi-charts platform, and the same goes for this test. However, instead of using the normal platform, I actually used multi-charts portfolio tester to test out this strategy, although I could have done it just with individual charts on the regular platform too. And this is what multi-charts portfolio trader looks like. This is just one of the portfolios which I've created. I've actually created 4, and for each portfolio I've got a different time frame. So as you can see at the moment in the instruments list, these are all the Forex pairs, and they're all running on the 480 minute or 8-hour time frame at the moment. Signals, we've just got one strategy, and it's the same strategy across every one of the charts. Okay, so let's have a look at the results. And we can see these results as a whole portfolio, so with the 10 pairs combined, but that doesn't really tell us very much, especially as we're looking at different currencies. Some are in dollars, some are in yen, so that's going to kind of skew our results a little bit. But what we can do is we can look at the breakdown of symbols, and we can go through individually looking at how each market performed on that 480-minute time frame. And looking through at the net profit, we can see that every one, apart from New Zealand dollar, US dollar, every one of them actually made a net profit. And we can individually go through looking at the individual performance reports for each of the markets on the 480-minute. These are the equity curves. I'll quickly go through those. So that was Australian dollar, US dollar, euro pound, euro yen, euro dollar, pound yen, pound dollar, New Zealand dollar, US dollar. We can see this one does make a net loss. Oh, and we can see why. US dollar, Canadian dollar, US dollar, Swiss franc, and US dollar, Japanese yen. Of course, you can pause the video if you want to have a better look at any one of those equity curves. And I won't show you the other three portfolios for the other three different time frames. What I'll do is I'll switch across and we'll look at the little spreadsheet that I've put together, which gives us an idea of the better and the worse performing markets and time frames. And this is what that chart looks like. We can see the Forex pairs down here and the time frame across the top. And we have a traffic light style color-coded system where the greens are the yeses, and what that means is yes, I definitely see potential for this smash bar setup to work on this time frame and on this pair. So on the 240-minute time frame or 4-hour Australian dollar, US dollar, I see there is potential, and it's definitely worth looking into further. Just because I've said yes doesn't mean that it's tradable straight away. It means that it's worth looking into further and looking at adding some extra improvements, which we'll talk about a little bit later on as well. The orange is self-explanatory. It's a possible. It's, yeah, maybe, again, they are worth looking into, but you want to be spending your time looking into the green ones mainly. And the red is flat out no. It's terrible results. Don't try and improve what is already a terrible result. So you can pause the video and take note of that. And next we go over to multi-charts and look at the individual 13 charts, which were the yeses, just to see what the results for those are like. But just before we do that, if you're looking for some more rule-based trading strategies, then you'll probably like to download my 22-page Beat the Markets Strategy Guidebook. And in that, I actually outline and I list the rules for 3 more proven rule-based trading strategies. I'll leave the link somewhere down below, probably in the description down below, so you can get that absolutely free. But better still, you can enroll in my popular trading course. And amongst a lot of other different lessons, there's 6 more profitable trading strategies listed there. And if you're a multi-charts or a TradeStation user, you'll find it particularly helpful because I've actually listed the code in Power Language or Easy Language format. But if you're not a TradeStation or multi-charts user, the strategies are still simple enough to trade manually, placing your orders manually with your broker as you normally would. The links for that will also be down below. Okay, let's have a look at the better 13 charts for this smash bar setup. Okay, so we saw from the previous chart that none of the smash day patterns on the 30-minute chart were very good. There was a few possibles, so we're not going to look at those here. We're just going to look at all the green ones. So we start off here with the 240-minute charts, and we'll just go through them one by one so you can have a look at the results. First off is Australian dollar, US dollar. There's the equity curve. Importantly, let's look at the average trade value. Now, none of these results you're seeing have got trading costs included, and I can tell you that an average trade value of 17.85 is actually far too small by the time we've paid trading costs. I would want to see an average trade value in excess of about 80, so this is far too small at the moment. Euro pound, again, small average trade, but pretty consistent behaviour in the equity curve. So with some improvements, we might be able to do something with this. Euro dollar, there's the equity curve. Average trade again, still small, 18. Dollar, Swiss franc, small average trade, too small. But the equity curve, apart from early years, does show some consistent behaviour. And then lastly, for the 4-hour, pound dollar. Nice smooth equity curve, but I suspect, yeah, a smaller average trade. Better than the others, but still a little bit small by the time we've paid trading costs. It will probably be a money-losing strategy. So we do need to make some improvements before trading this. Moving on to the 480-minute or 8-hour charts. Australian dollar. Small average trade still. Not a bad equity curve. Euro yen. Equity curve's not that great. It's been doing very well recently. Average trade 5,400, still a little bit small. The equivalent to $80 would be looking at about an 8,000 yen average trade and above, ideally. Pound yen, nice uniform equity curve, and a better average trade, 8,800. We get into something that's possibly usable now. Pound dollar, 66, that's jumped up from looking at the 4-hour chart. And the equity curve is okay. And lastly, on the 8-hour, US dollar, Canadian dollar, equity curve moving in the right direction. Average trade only about 46, so still a little bit small. Finally, let's look at the 720-minute or the 12-hour charts. Pound yen, average trade, much better, 9,500. This is something that once we've paid costs, we've still got some profit in, so that's quite good. Although the equity curve's not as nice as some of the earlier ones. New Zealand dollar, US dollar. Equity curve is going up, but it's not the best. And the average trade is very low, so that's not as good as some of the others. And lastly, we're looking at US dollar, Japanese yen on the 12-hour chart. Average trade just over 9,000, that's not bad. Equity curve was nice up until around about this point, so up until about the beginning of 2008, and then it just sort of stopped working. The behaviour changed somewhat for some reason. So some of these equity curves we've seen have been okay. Average trades are typically low on all of them, but we can improve that with some extra improvements, and I'm going to talk about those improvements which we can test out shortly. Some of the equity curves are showing consistent, decent behaviour using this smash bar setup, but the edges or the average trade are just not large enough to overcome trading costs at the moment. But there are ways that we can improve on that, and I've created a short list of the type of tests or improvements that I'd be looking at testing next using this pattern. I'm going to run through this list of 9 improvements, which is certainly worth looking into, not only to improve maybe the equity curve strategies, but mainly to bring up the average trade value. Essentially, we'll probably end up filtering out trades, filtering out some of the worst ones, and that will in turn bring up the value of the average trade, which will help when we introduce trading costs. So the first one we want to look at is the reward to risk ratio. None of the strategies have been optimized yet, and I mentioned we're using a fixed reward to risk ratio of 2 to 1 across the board. You might find that some strategies work better at 1.5 to 1, some might work better at 3. This is something that can be tested and possibly optimized. Number 2 is the stop loss placement. We know where the stop loss placement is. When we're going long, the stop loss is at the bottom or at the low of the smash bar. But is that the best place? Maybe that's too close. Maybe a fixed pip stop of 100 pips might work better. Something worth looking into. Number 3 is daily filters. This is something I often like to use, especially on intraday strategies. For example, has there been some indecision or some sort of compression within the last few days? Maybe yesterday was an inside bar, which means that today could quite possibly break out and have a decent move in some direction. It's worth looking at these types of filters. Number 4, looking at the lowest low and the highest high. When I use the smash day pattern on the daily chart, let's say we're going long, so we're looking for a buy trade, and the close of the smash bar takes out the low of the previous bar, but it also has to take out the low of the previous, say, 14 bars, and the same when we're going short. That's something I haven't looked at in today's testing, but worth looking at. Number 5 is the time of day filter. This is especially applicable to lower time frames like a 4-hour chart. A 4-hour chart has got 6 bars within the session, so we've got 6 4-hour bars within that 24-hour session. If we were to take some of those signals during certain times of the day, they might be insignificant, whereas some of the times of day might prove to create better profits. So it's worth looking at the time of day. We can use the smash bar setup as a fine tune as an entry. Let's say that we're overall bullish and we think that the market's going to go up for the next week or two, and we're looking for a good entry to get in to go long. Then we might be looking for a smash day long setup to get us into that longer term uptrend. The next 3 improvements, just going to be talking about exits, and the first one is looking at an end of day exit. They often work quite well with intraday strategies. An exit after an X number of bars, so exit after 5 bars, exit after 10 bars. I like to use this type of an exit to help me gauge how robust the entry is. If I say exit after 3 bars, exit after 6 bars, 9 bars, 18 bars, and I see that they're all profitable, I've got a good idea that our entry signal is a robust one with an edge. And the last one is just a first profitable close. That means if we've entered intraday and at the end of the session or at the end of the day we're in profit, then exit and take the profit. If we're not in profit, then leave the trade running. I'll often use this first profitable close, and sometimes I call it a bailout exit. So that's 9 different ways which I will look to improve the smash bar setup. Well, that's about it for this video. So I hope some of you found it interesting and perhaps helpful. I will continue my studies using this smash bar pattern on the intraday charts and testing out some of those improvements which I outlined earlier. If I find anything that works particularly well, I'll probably do another video and share the results with you. The takeaway from the video is patterns which work on daily bars particularly well will also sometimes work on intraday charts, but rarely will the edges or the size of the average trade be large enough to overcome the trading costs trade after trade. And as I always find with algorithmic trading strategies, just because one particular setup works well on one market and one time frame doesn't mean that it should work across all time frames or all markets, because the Forex markets, like other markets, they all move differently to one another. Okay, well, if you've enjoyed the video, please give it a thumbs up and I'll see you in the next video. But until then, this is Jared Goodwin, and thank you.